Hello, thank you for joining KraneShares webinar. So today we're going to talk about AI outlook for 2025. Artificial intelligence has been going through some exciting development over the last year. We have seen the AI reasoning is being very good, multimodality and AI agent, especially AI applications being really accelerating across enterprises and consumers. And just earlier this year, we have some breaking news from China that DeepSeek's R1 reasoning model is really bring down the cost of reasoning and training while deliver quite strong performance. So that's creating some volatility in the AI space. So every investor is now wondering, how should I position for the AI investment in 2025 and beyond? So today we're going to have a discussion with some honored speaker guest from Etna Capital Management. Bier is the partner and portfolio manager at Etna, and Chen, the executive director and portfolio manager at Etna. Before we start the discussion today, I just want to remind everyone who joined, if you request the CE credit, please email us at ce@KraneShares.com. And during the presentation, if you have any questions, you can ask in the Zoom or you can email us at info@KraneShares.com. So going to the next page, I'm just giving a brief introduction of KraneShares for anyone who for not familiar with us. We started business back in 2013, based in New York. We're trying to create the most innovative investment solutions for our clients globally. We're trying to bring the long-term growth opportunity for our clients to capture the most exciting investment opportunity around the world. Look at the next page. You can see our investment solutions range from China, climate, alternatives, and of course, global investment opportunities. And we believe artificial intelligence is probably the most exciting investment opportunity for this decade. So that's why we created AGIX. In the next page, you can see AGIX is really investment solutions. We want to get the investors ready for the AGI, the artificial general intelligence. We believe artificial general intelligence could come sooner than people expected, and we are a true believer of AGI. And AGIX leverage a proprietary AI exposure score that we developed together with Etna Capital Management to creating an investment solution to capture the value coming out of the large language model and Gen AI. Etna Capital Management is a pioneer in the AI venture investing world. They have invested some of the most exciting AI innovation companies, including large language model companies like Anthropic, and XAI. Also, they have invested some AI native application companies like Perplexity. Actually, Perplexity, they have been talking about like a merger acquisition with TikTok, and also Perplexity has incorporated DeepSeek's model in their platform. So it's all like very exciting opportunity, and we really appreciate partnership and their deep knowledge and thought leadership in the Gen AI world. So AGIX is really the AI score centered around how a company is really integrated with the large language model and benefit from the impact of those model capabilities and the potential catalyst from the AI adoptions from those large language models. So going to the next page, you can see that since we launched AGIX back in July 18, 2024, AGIX has delivered some amazing performance compared to many other indexes. Since inception, we have delivered 21.81% compared to S&P 500, only up 9%, and NASDAQ around 9%, while semiconductor index was down 4%, and many other AI index also was only up like 14%. So why is that? I think one of the reasons is the AI score that we developed with Etna is really adding some value here, because some like AI companies is really not in the benchmark of NASDAQ 100. For example, we have invested in Palantir since the beginning, and Palantir has delivered more than 258% since we launched AGIX. And that's amazing result, and that's not even in the NASDAQ 100 index when we start our investment. And of course, another benefit of cooperating and work with Etna is their deep connections with the large language model companies. So even before the DeepSeek, I think Etna has already identified a trend that AI scaling law has hit a wall for the pre-training, and cost of training and inference is really coming down. So that's going to create some volatility in the AI hardware space while benefit AI application. So back in November 2024, through our AI score framework, we have lowered the weight of AGIX in the AI hardware by 10% and reallocated those weight to the AI application side. So that's really helped us beginning of this year when DeepSeek announced their R1 model, and there's huge volatility in the market, but actually AGIX is doing well through this volatility. So I'm now gonna turn it to like Max and Solomon. So in the next page, you can see like Max and Solomon, they have a deep connection in the industry. So last year we had a NASDAQ AI Day where we have invited like a company like Anthropic, Perplexity, Palantir, and Duolingo join our discussion. So like now I'm gonna just maybe Solomon, maybe you can share a little bit about your background, like how you know those companies and how you find those investment opportunities.
Yeah, Derek, thanks so much. And I'm glad to be here. My background is I've been active in the AI space as an engineer and an entrepreneur since 2013. So I was a BS physics major at USC, and then I left, graduated from university and joined Cruise Automation. So that was one of the self-driving car startups at the time. It was a small team when I joined, and I worked on everything from motion planning to line of segmentation to computer vision. It was a great experience, and we ended up selling the company about 2.5 years later after raising venture capital funding. We sold it to General Motors for about 1.2 billion. And then we would go on and scale the team further. The company ended up about 3,000 employees by the time that I left, and then joined Etna as a portfolio manager. And the experience was great. Since then, we've focused a lot on the AI ecosystem, similar to the engineers that were at Cruise. And we focus a lot on both the foundation model layer and application layer, really in 2020, 2021. And we started getting really excited because we were following a lot of the engineers at OpenAI. The company was founded in the late 2010s. It really started to get traction around 2018. And they had released original GPT 0 and 1 results, which weren't quite at the level that people use today, but they were still a great leap forward. So we were waiting for that GPT 2 and 3 release. And we were potentially thinking about using it at Cruise at the time if it got performant enough. So that's how we knew the engineers in the ekosystem. We actually were pretty close with Perplexity and Anthropic. We had an event with Anthropic and Perplexity in New York City with KraneShares and an AI Day, as well as some other public companies, both Duolingo and Palantir. So deep connectivity in the AI space and really excited. Max, we'll hand it over to you to give your background as well.
Yeah, thanks. So I have more background in the investment side rather than engineer side. So I used to work at Sequoia, and then work at Ping An Asset Management. So it's one of the largest asset management in Asia. And I would say we had a relatively good performance in the private market. Like So have mentioned that we have been an investor in Anthropic, entered at 4 billion valuation, and now it's valued at 60 billion. And Perplexity have grown from 300 million valuation to 9 billion as of today. So our strong performance actually rooted in 2 dimensions. One is like So have been already introduced, we have a strong engineering background, so that we have a vast network of engineers, allow us not talking to the executives who are IRs of the portfolio companies, but also the builders of the companies. And second is we are a very research-driven firm, so we focus a lot on understanding the technology side of the current AI because we still think that right now it's still a research-driven field. So we want to stay ahead of the technology curve in order to navigate in this fast-paced industry.
Max, I also know you have connected the team of DeepSeek with the founder of Perplexity. Like, maybe can you share a little bit about that story?
Yeah, I think like 2 years ago, we already identified that DeepSeek has the potential to become one of the leading AI firms because, like I said, we focus a lot on the researchers. So we gauge, the potential of the company not only by their business model. Like I said, it's still a research-driven space. So based on the research quality of those frontier labs, we identified that DeepSeek has great potential. But they are hedge fund by nature, so they don't need external investors. But we maintained that relationship until today. And when DeepSeek released V3 and R1, and Perplexity is really like sensitive about the business opportunity, so they reached out to us and saying, if you guys could introduce DeepSeek, we want to integrate DeepSeek in our product, which actually bloomed into better version of Perplexity that allow a lot of users have been driven back from other AI chatbot like ChatGPT back to Perplexity and praise about it, saying it's much better, especially when reading the trace of thoughts provided by R1, which have been hidden by other AI apps like ChatGPT.
Well, that just laid the foundation for our next discussion. If you're going to next page, so Max, do you with that relationship with DeepSeek, do you want to share some your latest thoughts on the impact of DeepSeek latest model?
Yeah, I think DeepSeek is not only about DeepSeek, but it's about the implication of the open source models, which makes the technology more accessible and more affordable. So by accessible, I mean it really accelerated innovation by democratizing the model training techniques to the AI community through open sourcing, and also they open source the method that actually works. It actually reduces the waste of other firms like exploring all those techniques to see whether or not it works, and then waste a lot of resources and money in experimentation. So the second is that it actually accelerates AI adoption. So although a lot of people question its origin, but we should remember that it is an open source model and you can self-host it. You can download it from internet to your own PC, to your own server, and ensures that no data flows externally. So before, enterprises don't have that option. They have to use the costly open API while worrying about that their data being used to train the next frontier model. But right now they can self-host those DeepSeek models, which are really capable and on par in performance with the closed source model companies. They can do whatever they want. They can distill it, they can fine tune it, they can customize it. It will definitely boost the AI adoption in enterprise use cases. So by affordable, yeah, sorry.
Sorry, how about the implication for the AI hardware? I know Etna team has lowered the score of AI hardware back in last year, given the trend of the cost of training and inference going down, and you said AI adoption is rising. What's the short-term and long-term implication for the hardware companies like NVIDIA?
Yeah, that's a great question. I think the implication for computing is profound, but I don't think it's because of the DeepSeek. DeepSeek is just a signal. So a lot of people notice that DeepSeek claim that they only use 6 million to train their latest model, but actually it is because the reinforcement learning and test time computing paradigm shift that will influence the computing demand. Before you have to connect a large class of GPUs in order to train the next frontier models. But with the reinforcement learning, you don't need to connect those large amount of GPUs, but relatively a small cluster would do the work. And even it could be distributed clusters in the future. But paradoxically, that cost reduction will actually introduce more demand for computing because it's cheaper and it's better. So that's our short-term view that the semiconductor overall will be more and more bifurcated. For NVIDIA, it will not be a good story for them, but for ASIC, related stocks, they will enjoy a good time going forward. But at the same time, in the long run, we are still a believer of AGI, and right now we are still in shortage of computing power and also in energy.
That's great. Now I'm gonna turn it over to Solomon Bier to share his thoughts on, maybe you have any thoughts on DeepSeek or to the AI development in the latest trend.
Yeah, I agree with everything Max said. We still see compute shortages, so I think people are a little overly optimistic thinking that the DeepSeek breakthrough, which is an incredible breakthrough. I think we're not too surprised about it because I think myself and Max would joke that oftentimes the US versus China AI competition was really a competition between US, American, Chinese versus foreign Chinese engineers in China. So we've known the team there, and there's incredible engineering talent. But we still see shortages in energy and compute. And we spoke to Anthropic this week, and they kind of reiterated that they blew through all of their metrics in terms of revenue for 2024. But even with that, they felt like they were hamstrung by some compute bottlenecks. But we did, AGIX portfolio did see the DeepSeek chips were released coming and did shift the portfolio allocation to reduce allocation to semis as it got overweighted in the indexes last year. So that was a good outcome for us.
That's great. So Solomon, do you want to just give the your outlook for the AI and what's the opportunity for AI in 2025 and going forward?
Yeah, so we're starting to see some significant adoption now at the enterprise. So we see AI as a real technological wave. We saw previous tech waves and shift in usage patterns and business patterns and creation of new business units or business paradigms. We had mobile and cloud computing and entire new ways of selling software. We're kind of seeing that now with AI. Originally, it was mainly just a chatbot interface where you can maybe ask questions and do quicker search, but we're starting to see applications come out that involve agents or interacting with multiple websites across multiple applications. So this is really creating a value-based pricing opportunity that traditionally hasn't worked well in software. We're also seeing companies in the robotic space and autonomous driving, especially robotics, companies like Physical Intelligence or Botco, continuing to take these advances from companies like DeepSeek or others and integrate them. And traditionally, robotics had issues because there was a limitation of data to train on, but we're starting to see that slowly getting solved by some of the advances that we're seeing in the AI ecosystem. We're also seeing potentially some risk SaaS-based pricing, including companies that rely selling software via subscription that potentially can get disrupted by AI via value-based pricing, or just bringing down the cost of developing software and the cost of developing a new company. And we're also seeing potentially companies integrate AI and use it for pushing the boundaries of scientific research and manufacturing. So we're pretty optimistic when we looked at the cloud and mobile adoption curve and even the desktop computing curve. The beta exposure in that asset class kind of outperformed the beta in the overall market for a period of at least 5 to 7 years. So we still think, if we think 2022 as being the really first year of AI, we still have a considerable amount of runway to go. We see US employment data still pretty strong. 73% of companies are actually exceeding earnings in 2024 Q3. We do see inflation somewhat under control. It's somewhat flatlined. And we're not seeing that really affect enterprise decisions. That was a key concern for us, is regardless of the argument of whether the US federal government was cherry picking certain data, they include what we wanted to see is enterprises making business decisions. And when there's a significant inflationary environment, they sometimes will pause or delay large purchasing decisions. We're not seeing that as anymore. And obviously, this new administration is considerably more business friendly, especially domestically, than they were previously. So the expectations of the market will grow by 2.5% in 2025. The overall US market is pretty optimistic, even with the performance of the last 2 years. I don't think the average stock market participant was that optimistic, and that's a new shift that we're seeing in this cycle. And we're seeing major developments in AI applications. I mean, it was not even we weren't even through the first month of the year, and we had one of the biggest breakthroughs in AI. So, 2023 and 2024 are really about the tech infrastructure, which is really the hardware layer, semi layer, utilities. We're paying attention to is in earnings reports is how this is going to start flowing through the application layer and especially the enterprise layer. So we want to see increased penetration rates in enterprises. We're starting to see that. We're starting to see large enterprises, the large banks and financial service companies, the slowest adopters are starting to adopt AI, which is a good sign for us because it can be pretty late in the adoption curve. So that's a good sign. So those are the things that we're focused on. So we're pretty optimistic for this year.
Go to
You can go to the next
page.
slide, then. So where are we in AI development? I think we spoke about this before. We look at parallels between the Industrial Revolution and the build out of the railroads and the infrastructure within the United States and elsewhere, the development of the PC revolution, the desktop computing, and then the build out of the cloud computing. All of these started with a hardware or infrastructure layer which needed to support the next phase of growth. In the PC revolution specifically, you had companies like Texas Instruments or Intel. They were really started, they focused a lot in memory chips and then moved to logic chips. And that was a big boom within the US. And we saw a big paradigm shift with Intel and their processors that would power a lot of the desktop computing. Companies like Dell, HP competing with legacy companies like IBM, and that allowed the beginning of the software market to flourish. Companies like Microsoft, Facebook further on, especially with mobile. Cloud computing, we saw the similar things. Companies like Broadcom or IBM, starting, especially IBM resurging and allowing to lay the foundations for companies like Amazon, the AWS, and Microsoft Azure. So we're seeing the same thing in AI right now, where we have NVIDIA and a lot of these ASIC companies building the foundation, optimizing CUDA, engineers building infrastructure to allow deployment of AI applications across multiple hardware and the standardization of a lot of formats in the AI ecosystem. That's where we saw the last 2 years, and we see a lot of the performance in the market come from those past 2 years, come from semi and utilities. That's why semi margins were so high. And 2023, 2024, we felt the large companies were going to benefit. Towards the end of last year, as we mentioned, combination of us and Max being close to the DeepSeek team and us anticipating potentially pre-trading slowly starting to taper off in terms of performance benefits, we shifted the allocation weighting away from semis to application. So this year, we hope when DeepSeek is kind of ringing that bell in 2025 is the beginning of the application layer. So we're looking at companies like Salesforce, which is already up considerably, Monday.com, Palantir, which just had incredible earnings, Snowflake, Duolingo, Apple. On the private side, companies like Databricks are companies that we think will be massive adopters, regardless of whether the LLM price increases or decreases continue, but will adopt from increased usage. So that's really the focus for 2025.
Last page.
Yeah, so we're going to talk about agents, so AI agents, and this term is thrown a lot, and we see it a few different ways. People are using agents right now as ways to do automated tasks, that it can reason through 2 or 3 tasks, but that to us is not a true agent. Agent should really be able to interact through the entire OS layer and interact across multiple applications and execute instructions. So now we're starting to see what we call software 3.0. And we've looked at a few companies in the Bay Area that are early, that have been invested in by a lot of large VCs and a lot of large corporates, actually public companies that are excited about the space. It reminds us of RPA with UiPath, where you have in the enterprise increasingly complex workflows. You need to search the web. You might need to search your internal database. You're then going to distill that information, summarize it, maybe summarize it on a slide like PowerPoint or Excel, and then pull information across other files that maybe that you saved, and then execute against instructions that you want it to execute within the OS layer. So we're starting to see potential companies come out. So companies that are able to take advantage of being able to communicate across the infrastructure layer, and that's where we see opportunity. These companies are still pretty early. So we think that if companies that are going to benefit from the AI revolution, especially AI agents, to be able to architect their products, to be able to communicate with these agents. So companies that maybe add an API so that agents can communicate, or add a security provision that not only can agents read from your data repository, but actually execute against your data repository. That also adds significant security risks. So there needs to be investments in the security provisioning to make sure that these agents are doing only specifically what they should be allowed to do. So we see this as a massive opportunity, and we see it as a new form of new business form, similar to how SaaS was a business form, where this potentially could be a worker that you're paying in an hourly rate or a per compute rate, where you're paying it based off the amount of instructions or the amount of time that it's running, almost similar to a virtual employee. That's pretty new, just like software as a service was new when we shifted from selling software on a CD-ROM to selling it over the cloud and paying on a monthly basis. So this is pretty exciting and a brand new paradigm for the software industry. So in terms of agents, you can see it can potentially lower sales costs because instead of selling on a per seat basis, you're selling on a per compute basis. So that's value-based pricing. That typically hasn't worked in software. Sales-based pricing tended to be the dominant. But it's not necessarily the most user-friendly because companies are optimized to sell as many seats as possible, regardless of usage. And then you end up with this paradigm where the customers will then need to check every year who's using the seats and renegotiate. So this fundamentally changes a huge pricing revolution. We can get to volume-based pricing and value-based pricing, and some workflows are more valuable than others. So it also creates complication for the company selling AI agents because you need to be able to come up with strong value-based pricing that prices each task or each virtual worker appropriately. We think the winners will blend this model, so it'll be a mix of sales and computational pricing. We see Anthropic and OpenAI doing this right now. It's a very crude version of what we're talking about. They sell seats, so a per seat basis on their ChatGPT teams, and then they sell compute-based, value-based pricing on just their API. But this is a simple API, so I think they're going to take it a step further, where they're discussing having plans where it's a minimum amount per month, and then any additional compute beyond what you use will be based on a per token basis. This creates new markets as well for customers, maybe those in the audience that use ChatGPT or Anthropic and you use it very heavily for a few days out of the month, but maybe you're not using it for the rest of the month. You can maybe pay a lower monthly rate and then only pay a per usage base on top of that based off the usage that you have. Maybe you're writing an essay for college, or maybe you're doing a presentation for work. So we see this as a new opportunity and also a risk. Some public companies that are still only relying on the SaaS model. So a case study for us is Agentforce. So this is a very early implementation of agents. So essentially, their Agentforce was launched. Return for Salesforce is about close to 40%, 38.5% since AGIX is launched. So Agentforce integrates across multiple functions: sales, service, and marketing, and the data cloud, especially if you're using Salesforce Cloud. So it's also Slack as well, which is technically a different application. So it integrates this all across the single platform. It has access to each different data repository, and it's able to integrate both the data and workflows across these ecosystems. And I don't know if for those who have used Salesforce, if you've used Process Builder before, that was pretty cumbersome. You had to manually define each process. Agentforce is moving to an area where it's charging based off usage, and it's slowly being able to figure out what you don't need to define in strict terms, and it can translate to you how to execute that on each specific, whether it's Slack or Einstein or Salesforce marketing or service. There's many different products that they offer. Since they launched the product, and I think they charge $2 per conversation, they have about 200 Agentforce deals signed already in a single week. And they think that it's going to be one of the strongest drivers of both revenue growth and incremental profit for the company, because they're not actually necessarily building a whole new business vertical like sales or service. They're just increasing the potential usage between cross collaboration between the company. So we're really excited about Salesforce, and obviously it's been a great return for AGIX and the market overall. So this is one example of AI agents really really standing out. The other example is ServiceNow, also a company we're excited about. Similar, they're using customer accumulated knowledge and what would they call knowledge graphs to do automation, automated workflow generation. So for those that have the Pro Plus subscription, which is apparently the fastest fastest growing penetrated product in ServiceNow's history, it includes things like AI chatbots and the summary generation into major product lines. It's priced significantly a little bit higher than traditional Pro pricing, but they're seeing some strong adoption. So there's clear demand, even with the increase in pricing. The company's estimate on TAM is a larger than 1 billion within 2 to 3 years. So that's about what 9% of revenue, 10% of revenue for 2024. So it's a pretty significant TAM and pretty significant increase for the company in just 1 year. So you could see a lot of these AI agents or the AI applications are the ability to drive incremental revenue and incremental free cash flow for some of these companies. So it's not only brings in new customers, but it increases the amount of monetization with their existing customer base, which is really powerful and changes the way we underwrite a lot of these larger enterprise companies. And then going beyond just these AI agent applications, we've broken down the universe into 6 major areas. The left being the semi and data center. So this is more the infrastructure layer. So in the semis, companies like TSMC and ASML and Synopsys are companies that are maybe creating the fab or creating actually powering the semiconductor market and supplying companies like NVIDIA. Then we have companies in the data center space that are providing kind of server racks or hardware so that companies like Azure or AWS are able to build out these GPU clouds. Companies like Broadcom as well, which sit between the two, that are innovating in optical interconnect. Then we have companies that are innovating in edge AI. So things like DeepSeek really power these companies because as the models potentially get smaller and more cost efficient, they can kind of sit closer to user devices. So companies like Apple are beneficiaries, ARM with its more efficient architecture, companies like Qualcomm, which is very, very strong in mobile, and SK Hynix. And then on the right-hand side, we're more focused on the AI model and application layer. So companies like OpenAI, Anthropic, xAI, all incredible companies that are innovating very fast. On the application layer, we have companies like Perplexity, Adobe. So Perplexity, which is really competing with Google, offering both an enterprise and a consumer product for AI search. Adobe, which is integrating products like Firefly, where you're able to generate images and use maybe the latest AI image models that are based off Stable Diffusion. Salesforce, which we spoke about previously, Intuit. And then obviously we have the cloud companies, which are kind of benefiting from all of these. They're powering the application layer. They're powering custom workflow. So if you're using an AI API like an OpenAI or Anthropic's API, as well as some of the cyber companies in the space like Palo Alto Networks, Zscaler, and then companies like Databricks and MongoDB that are powering a lot of the database usage and storage that have exposure to the AI ecosystem. So this is the universe that we've mapped out beyond just the Mag 7.
Thank you, Sol. Yeah, just based on Sol and Max's great work in Etna, and we partner to build an AI score that's really mapping out the investment universe of artificial intelligence. And we think, just as Sol said, the investment opportunity is really beyond the Mag 7. If you just look at the top 10 holdings in AGIX, you find like a lot of similarity compared to like NASDAQ 100 or many tech or growth related index. But if you look at the portfolio, it's more than 40 companies, and there's a lot of maybe players like Palantir mentioned was not even in the NASDAQ 100 index. And there's many other examples. If you go into KraneShares.com/AGIX, you can look at whole like full holdings, and there's many companies that's really not like as people really think about like, oh, big tech. So just look at this page. We have been invested more than just on those like Mag 7 because the opportunity is really multifaceted. Like from like infrastructure side, you have the hardware company where you provide like chips and chip design, manufacturing, packaging, but also the power, energy, cooling for data centers. Then on the model infrastructure, you have cloud and you have everything related to large language model. That's really helping the cybersecurity, helping the data storage, data preparation. That's really creating this the model capabilities, computing for the application side. And also you have the model deployment company, for example, like Palantir mentions, creating this context layer for enterprise to use those large language models. And also those like SaaS and software 3.0 opportunities that's so just mentioned in the AI application side. So the opportunity is very diversified. It's really requires the knowledge and understanding into the model, into the latest trend in the application side, into the AI agent. So in the next page, you can see that with all that framework, we have building a process-driven methodology for AGIX. Starting the universe of 2,000 to 3,000 companies, we narrow down the universe of looking at their liquidity, looking at their market cap. So that's about 300 to 400 companies in the AI-related industries. Then most importantly is we look at each of those companies and assign the AI exposure score, which Matt's later gonna talk about how the AI exposure score with the philosophy behind it. But it's really centered around their knowledge and connections and see how the company is really integrating the large language models. With that score, top ranking company is going to be included in the index, and weighting is going to be reflecting on that AI exposure score, but also their free float market cap. So market cap is a factor in the portfolio. Just acknowledge their importance in the capital markets. So we do have a cap on the industry as well. There's a 40% cap in each AI industry, and there's 10% cap on a single name. And this process is done quarterly. So with that, I'm going to turn it to Max and talk about the philosophy behind the AI score of AGIX. Max?
Thanks, Derek. So like Derek have mentioned that we maintain a proprietary AI score. I would say it's a relatively sophisticated system that help us capture the value of AI advancement within our portfolio companies. So our AI score is actually built on two pillars. So the first pillar, we call it AI readiness on the right. So it actually looks ahead to evaluate how AI can transform a company's core business, predicting whether there will be a potential revenue because of AI adoption and at what scale, right? So for instance, last year we identified Duolingo as an AI potential winner, even before they actually launched their features like Duolingo Max. So once that did, the market rewarded their innovation and Duolingo becomes one of our top earners. So the second pillar on the left is called AI relevance. So it assesses the current impact of AI on the company's revenue. So it evaluates how much revenue AI-related products contribute to the company and also tracks changes in these contributions. It actually offering a more realistic perspective on the company's performance. For example, Apple Intelligence, before the Apple Intelligence is released, we give them a relatively low AI relevance score, but after release, we increase the score, which is also rewarded by the capital market because the capital market also recognize their advancement in AI adoption, right? So these two pillars actually provide a comprehensive framework that help us not only identify current AI winners, but also spot potential ones. So our goal is to capture the full value of our portfolio companies, not just betting on the consensus winners like NVIDIA, but leveraging our insights, especially from the private market, to identify future leaders in AI. Next page, please. So on this page, I'll discuss one more layer that complements our proprietary AI score. So after assigning each portfolio company an AI score, we add another layer focusing on the industry and vertical dimensions to construct our portfolio. You could see that we categorize the technology advancement into three phases: hardware, infrastructure, and application. So currently we are still in the first phase, right? So focusing on AI hardware and AI infrastructure. So last year, like Derek have already mentioned, we allocated 40% to AI hardware, 40% to AI infrastructure, and 20% in the AI applications as a start. But however, by Q4 last year, we observed a slowdown in model training advancement and adjusted our allocation accordingly. We reduced our hardware allocation from 40 to 30, maintaining infrastructure at 40 and increasing applications to 30. So this proactive adjustment reflected market behavior where AI infrastructure outperformed and applications saw significant success as a result. Next page, please. So continuing with our methodology, let's look at how it reflected in our portfolio construction and performance, especially last year in Q4. As I said, we reduced our weighting in semiconductor and shifted to applications. So this strategic shift paid off, right? So AI applications accounted for 50% of the top 10 performers in our ETF, and companies like Palantir, Meta, CRM, and Duolingo were significant earners. So this trend highlights that investing in AI should go beyond just semiconductors or related products. So the rise of AI applications driven by cheaper, more accessible open source models present a valuable opportunity. It actually emphasizes the importance of diversifying investment within AI, so that we can capture the full potential of this transformative technology. Next page, please. So if you look at on the right side, out of the 6 months after launch, the product actually beat the benchmark performance in 5 out of 6. So if you have the data on a weekly basis, you could see a higher win rate, significant win rate over NASDAQ 100 of our product, which proves that, and validates the effectiveness of our strategy. But looking ahead to 2025, I think positioning AGIX well to capture value creation is crucial. So based on our understanding from the private market and evolving AI landscape, we still see the AI infrastructure, especially cloud hyperscalers, as the largest beneficiaries. So they not only provide backbones for AI applications to run on, and also provides large class of GPUs for model training workloads. And it also hosts numerous open source models will be showing up in 2025 because of the open source that DeepSeek inspired the industry, and enabling and encouraging enterprises again to train their own models on their infrastructure. So with cheaper and more accessible models from DeepSeek, we believe like AI infrastructure, particularly cloud services, will continue to thrive. But in contrast, AI hardware, like I said, despite strong growth in recent years, seems to have pulled forward future revenues over the last 2 years. So we expect its momentum to slow down a little bit. We've seen negative sentiment around AI hardware persist, and we've heard about the challenges like NVIDIA's earnings, air pocket, and the gap between the model capabilities and GPU requirements. So consequently, we've further reduced our hardware allocation from 30 to 25, maintaining infrastructure at 40, and increasing the application to 35. So on the application side, we see increasing adoption across various companies. Beyond early adopters like Duolingo and Palantir, we are now seeing companies like Tempus, Atlassian, Shopify embracing AI. Shopify, especially for instance, could benefit from a more fragmented market where chatbot actually facilitate online shopping experiences on their platform. Derek.
That's great. I mean, like just looking at the performance versus NASDAQ 100, I noticed like some months when the market was up, like AGIX almost doubled, and when like NASDAQ was down, like AGIX was quite stable. Just like amazing, like resilient, like compared to a lot of growth and technology indexes in the market. So now, like going to the next page, you can see that the AGIX is really a US listed ETF. We list on the NASDAQ exchange. So anyone with a brokerage account can buy through their brokers. And also, I think there's financial advisors, like the whole community, institutional investors, now increasingly use the ETF as an allocation tool towards their equity exposure. So we believe that AI in AGIX is like great investment opportunity for the long-term allocation and deserve a decent allocation in your equity portfolio to really capture the opportunity from the breakout of the large language model and AGI going forward. So you can see our total expense ratio is 1%. I think some investors ask about like why we're charging 1%, because what's unique about AGIX, the first is what we've been talking about today. The AI score that we partner with Etna is quite unique, and there's a lot of value coming from that. And also in our prospectus, you can see that AGIX has the capability to invest up to 15% into the private AI companies. So we're working very hard every day to get our first private investment into the ETF, and please stay tuned for that to happen.
Few weeks, stay tuned. There should be a nice announcement.
Yeah, so then like here's our top 10 holdings you can see as of January. But as Max just said, there's many other exciting opportunity in the portfolio. So for more details about AGIX, please check KraneShares.com/AGIX. With that, I'm going to conclude the discussion today. And we have a lot of questions already. So maybe just I think first question is for Sol. When you originally comment like it was competition between US and China engineers and China native engineers, is really a competition or is a collaboration?
It's a collaboration. A lot of the engineers kind of share research publicly online, and there's a very tight knit community in both the Bay Area. So there is collaboration. It's not complete competition. I think unfortunately the political environment has to turn everything into a competition. But the advances from OpenAI, from Google, from DeepSeek, everyone kind of learns from that and pushes the boundaries forward, which for you as an investor is great. So yeah, I agree. It's not entirely competition.
Okay, so another question. I see your primary holdings are like large cap tech ETF. What is your uniqueness? I think we already answered part of it. Like, I don't know if Max or Solomon, you have anything to add?
Yeah, I think stay tuned in the next few weeks as the privates are starting to get added. I think the goal is to have allocation of both large cap, mid cap, and private allocation tech.
Yeah, and also like even if you look at our top 10 holdings, it looks similar to QQ and other large cap holdings. But actually, if you look at the rest of the 31 holdings that occupies 50% of the portfolio, you see a difference, and that difference is actually our differentiator, which contributed our outperformance to the benchmarks.
Okay, next question. Can you identify some ASIC companies that may benefit from DeepSeek reinforcement LM technique? I don't know.
Nice trying to go. There's some companies on the private side that we can mention. Companies that we've looked at that aren't necessarily 100% beneficiaries. Max, did you want to add a few, and then I'll add some as well?
Yeah, I think on the public side, Marvell and Broadcom are obviously beneficiaries of inference or test time computing. A lot of them, don't have a chance in competing with NVIDIA in those large cluster of GPUs being connected together that empower the frontier model training. But a lot of those ASIC chips are relatively more effective or more cost effective in inference workloads. So which, the reinforcement learning workload actually will empower those companies to have a better time comparing with the last 2 years.
How would you rate the release of Apple Intelligence? The market opinion is a little bit disappointment as iPhone 16 supercycle has not materialized so far. Anyone want to?
Yeah, I think we consider it disappointing. I think they rushed with that OpenAI partnership. Wasn't entirely clear what the purpose of that was. It doesn't have. They're very big in privacy, so it doesn't have full OS level permissions. They've always had a closed source, a kind of closed wall ecosystem, so it doesn't work well in this AI paradigm where the AI agents or the AI applications maybe want access to all of the different runtime OS support or even other applications. So it's disappointing for us, but the advances and LLM training costs coming down and the cost of running inference coming down, I think is long-term beneficiary for Apple, but they haven't really capitalized on it yet. Max, I don't know if you want to add anything else.
Yeah, I agree. But we will also recognize their distribution channel capabilities, right? So with more and more powerful model being released, not only from OpenAI but also from other model companies, I think being a distributor, a strong distributor, would empower a lot of use cases that, for example, search, right? So a lot of people challenging Google because people have seen that the searching behavior have shifted from going to Google to going to different chatbots, right? So the search experiences have already been fragmented. But if you look using the iPhone, it's hard for a user to shift from iPhone to other, phones. So you have to stick with your device, and that device will empower and unlock a lot of use cases with the more and more powerful models. So we still recognize the potential for Apple being a strong distributor. So we'll keep a closer look at them, and as they advancing their model capabilities or their products in AI related products.
Okay, I've seen some investor asking about the risk of investing AI now. Is valuation a concern? So maybe we talk a little bit about like valuation and Max or Simon.
Yeah, I think there will always be some level of volatility. I think we had mentioned even before this NVIDIA run up, in terms of max drawdowns, and we like to follow this chart. Since just 2018 alone, there was at least 2 to 3 drawdowns of at least 55%. So the AI ecosystem will be inherently volatile, and that's generally true for any new technology. I think the analysis I bring to mind is in 2012, the Apple was down about 30-35% from its peak. And it had just crossed the number of headsets worldwide, had an equivalent to the number of desktop computing. People were questioning valuation. The valuations are kind of similar to the large desktop computing companies. The TAM looks like it's fully penetrated, and obviously that was very underestimated, and that was 4 years into the cycle. So we're not even 2 years, not even 2 to 3 years fully into the AI cycle. So if you truly believe that this is a new paradigm, it takes longer than 2 years for valuations to be fully baked in. So there will be some short-term run-ups, and that's why the volatility is there. But we just think you should be dollar cost averaging in and holding and think this is going to be a long-term investment and be mentally okay that there will be some drawdowns.
Yeah, I think like for a lot of investors who invest in the single stocks, oftentimes is more volatile than a basket approach. So that's why like AGIX is really creating a basket that's going to help you like run through some volatile period as some news like from DeepSeek or anything happen like with single companies, ETF and portfolio could actually help you better in the volatility. So next question, I think a lot of our investors are familiar with many of our other ETF. So their question around like the investment opportunity on China AI companies. Well, we do have a China internet company ETF, KWEB. I think many people familiar with. We believe is a great place for the opportunities in China AI. It's about Alibaba Cloud and many other like AI models now deployed on the China internet space. So KWEB can be like another option for if you're interested in China AI opportunities. So I think the next question is Mr. Bier suggesting that Microsoft and Google will be replaced? I think that's your early
So I don't think they'll necessarily be displaced, but some products will have competition, especially products like Microsoft Office or Google Search, and they'll need to innovate. So I think there's a lot of complaints on Google that its PageRank algorithm has been gamed recently. It's been kind of having a higher ad load across both YouTube and especially on the Google Search main product. So these products can take away market share, and our prediction, and we're starting to see this, is it will show up first in the Google network, which third-party advertising, because maybe you would have Googled what AI ETF should I buy, and you might show up on a website like Bankrate that has like 15 Google network ads and they have an article, but now you'll just maybe ask Anthropic or ChatGPT or Perplexity, and it will summarize for you what AGIX does. And you don't need to go to a link. So you're starting to see Google actually missed on Google Network. It's also an opportunity for them. We don't see it completely zero sum, but it will definitely push a lot of these companies to innovate. Yeah.
Yeah, I think the next question is very similar. I think this is really related to the discussion we have, like the AI startup and incubators. Like how we do own a lot of those large tech companies, but also like we have many other exposures. How do we see the challenges from the startups, and how do we see this balance between startups and big companies?
Yeah, I think that's the beauty of the ETF is we can kind of market cap weight it. So as next, I think hopefully by the end of this month, we'll have our first private name in. You should have, our goal is to have exposure at least 15% on the private side. So if these companies do start to disrupt and disruption happens quicker, these companies' market cap will increase, which will mean the weighting ETF will naturally balance towards the winner over time. So that's the approach that we're taking.
Like so have mentioned that we have a very sophisticated methodology. We're not only considering our own AI score, but also considering market cap weighting, right? So if those companies really grow really fast, and that will be reflected in our weighting. And especially this year, I think we have to remember that we are still in the early innings of AI. ChatGPT was only 2 years old, and this year we probably will see more AI native companies to become public. Companies like CoreWeave, like Scale.ai, they probably will be public this year or next year. And by then, we'll also include those names in our ETF, which will further differentiate our ETF from the traditional players like Nasdaq 100.
Great. Next question. You mentioned UiPath very briefly when discussing AI agent and RPA. Do you see it playing a central role in the AI agent enterprise automation space, or do you think there will be new winners?
I think they will play a space, but there will be new competitors as well. Some of the new competitors that we're seeing are taking a completely native approach, which is a little bit different than RPA automation. So our goal would be to have these companies eventually in the ETF as well. But yeah, UiPath in the short term can integrate or add some AI reasoning on top, but the fundamental architecture is still based off its original RPA architecture, which is a little different than either a full computer vision architecture, which can kind of doing action space based on what it sees on the screen, or actually using what it knows about OS level control system libraries. So it's a little bit different than RPA. So yeah, I think longer term we want to see a new paradigm, not just RPA stapled together with ChatGPT or Anthropic LLM.
Okay, we have another investor asking why only U.S. companies in the ETF. Actually, it's not. Actually, U.S. is I think about 90% exposure, but we do have many international exposure from Asia as well, from Europe as well. So for the full holdings, please check KraneShares.com/AGIX. I think we covered most of the questions. Maybe like any final comments from Saul or Max?
I think we're really excited this year. Pay attention to the updates on some private names being added. I think that's our big focus for this month in Q1. And now that the ETF's grown a little bit and we've got an allocation that we want on the public side, it's time for us to start adding private names.
Yeah, I think we are really excited about AI applications this year, especially given how the open source models have been showing up on par capabilities or performance as the closed source ones. So we really expect to see more inclusion of those AI native names, AI native applications, or some of the private names in our ETF, which will further differentiate our product among others.
All right, that concludes our webinar today about AGIX. Thanks everyone for your support to KraneShares and AGIX ETF, and thanks for listening.